This episode follows the map introduced previously. Nothing from that map is repeated here. We do not redefine layers. We do not change sequence. We remain inside it. In the previous episode, the market was divided into layers, and those layers were observed in order. Time frame first, session next, structure last. Here, we stay with one question only: why sessions exist at all? Not how to trade them, not how to use them, and not what to expect from them. Only why it matters: that the market is not observed as a single continuous day. Markets do not behave evenly across time. Price moves continuously, but participation does not. What changes is not the chart. What changes is who is active. Different participants enter. Others withdraw. Liquidity overlaps, then thins. Those shifts are not visible on a single candle. Two identical candles can represent very different conditions. One may form in isolation. Another may form as multiple participants overlap. Without grouping time, those differences disappear. That grouping is what a session represents. A session is not a time zone. It is not a clock. And it is not a trigger. A session is a shift in participation. It reflects a change in who is present, how liquidity is provided, and how much tolerance exists for price to remain unresolved. Without sessions, the market appears noisy. Movement looks random. Volatility looks inconsistent. And price behavior feels contradictory. With sessions, those same movements begin to show structure, not direction, not outcome. Structure, because the market does not resolve continuously. Markets resolve in stages. When one session ends, nothing resets. Ranges are not completed. References are not confirmed. Conditions are not finalized. They are carried forward. This handoff is not optional. It is structural. Price does not reset because the clock changes. It inherits everything that remains unresolved. What looks like continuation may only be inheritance. What looks like rejection may only be temporary absence. And what looks like indecision may simply be time passing without pressure. Most market time does not produce outcomes. It produces tolerance. How long price remains unresolved often matters more than how far it moves temporarily. Sessions allow that tolerance to be observed without forcing conclusions. They show when pressure is applied and when it is not. They show when behavior changes, not what that behavior means. Some sessions introduce conditions. They define space without asking it to resolve. They create references without forcing interaction. Other sessions inherit those conditions. They apply time. They apply participation. And they reveal whether existing conditions can tolerate continued interaction. This distinction is not predictive. It does not tell us what price should do. It tells us when the market is being asked to do anything at all. Without sessions, time is flat. With sessions, time becomes layered. And once time is layered, behavior can be observed without forcing interpretation. This episode does not assign roles. It does not label outcomes. And it does not define language. It establishes one thing only: markets are not continuous. They are sequential. Because of that, session-based observation is not optional in this framework. It is necessary. Episode 2 ends here. Nothing resolves. The market remains in balance. Or it does not. But we do not evaluate that yet. The next step is not to explain sessions further. It is to define how session behavior will be described consistently when observation begins.